Liquidity in microcap stocks is created by intermediaries. It does not happen organically.
Hi everybody, this is Value.Tokenized. Today our guest is David Weild. David, thank you so much for being with us today.
It's my pleasure, Masha.
So my first question would be, so you once said that USA currently has one-size-fits-all market. So can you share what are the main problems that private markets are facing right now?
Sure. I mean, first, that expression, one-size-fits-all markets, actually came from a paper that I wrote or co-authored years ago, and I think it was first picked up by SEC Chair Mary Shapiro. So it's quite a while ago, because since then we've had Mary Jo White as SEC Chair, and now, of course, we have SEC Chairman Jay Clayton. What we meant to say at the time is that it was really applied to public markets. And the idea was that we were trading microcap stocks, say, with a $100 million market value, the same way we were trading an Intel with a $100 billion market value, or an Apple with a $600 billion market value, whatever the market values are. And large capitalization stocks enjoy network effects, tens of thousands of investors looking at them all the time. And the best solution is to get out of the way and let the orders interact so that it becomes much more efficient. The stocks are naturally liquid and they support themselves, whereas microcap stocks trade, as academics refer to them, as asymmetrical order book stocks: big seller, no buyer. And there needs to be a structure, which there no longer is in U.S. equities markets, to have an intermediary step in and create the liquidity. And liquidity takes the form of research, because you got to be able to tell a story, salespeople that need to go out and create buyers with that story, and also the commitment of capital in market making. And those things were largely decimated when, all the way back in the late 1990s, we started this shift to electronic markets with penny increment trading. So in private markets, a lot of those same theories, once they trade, are going to be the same, except now you have to restrict private markets usually to accredited investors, and so there's a lot more legal documentation. And so in the blockchain space, where I think it can help is that you can actually have smart contracts which handle a lot of the legal and compliance and identification for know your customer, to help somebody very quickly and instantaneously say, this is a qualified buyer, and we can sell to that qualified buyer under the rules. So all of the legal checks, whatever they may be, and they may vary from jurisdiction to jurisdiction, can be automated. And in point of fact, we're working, I'm an advisor to a company that's based in Toronto, Canada, called Core Connects, which is actually run by a fellow named Oscar Joffrey, who's actually working on that very problem.
Yeah, we just interviewed Oscar, by the way, a couple of weeks ago.
Oh, you did? He's a great guy.
He is. Actually, my next question, I think it kind of relates to the work that Core Connects are also doing. So on one hand, there are a lot of entrepreneurs that are trying to raise capital. And on the other hand, there is a lot of private money looking to invest in companies. And for some reason, both struggle to do this. And do you think that tokenization can actually become this bridge between the two and just help both with their issues?
It may help. I mean, technology is not the solution, is not the sole solution. I mean, we have this discussion in the United States. It's a very large network of family offices, and it's knitted together with technology. But we find that most investors, serious investors, don't buy things over networks in private markets. They need somebody to pick up the phone and tell them the story, somebody to have knowledge of the account. And so it's actually one of the reasons why, we've done what strikes people as a very Luddite sort of thing. If you remember the Luddites in Brooklyn, that was in England, that were destroying machines and were standing in the way of progress. We believe that the death of the human being in capital markets transactions has been grossly overestimated, and particularly in private markets, where you need people on the phone that have a relationship with the account, what they're interested in, say, Xenia, Masha, I have something that I know you'll be interested in, and you'll know me, and you'll take my phone call.
Yeah.
And people that have a lot of money don't spend most of their time in front of screens surfing for ideas or filtering for ideas. They may get a junior person, and the decision to do that, if they do it at all, and the senior people really are still going to be much more relationship oriented because their time is valuable, and they're just not going to spend it surfing through large masses of ideas. In Weild Co, what we did was we were creating a first scale network investment bank, and we're supporting investment banking and placement agent professionals throughout the country. We're in 16 states in the United States already, in the District of Columbia. We'll go out this year with about 90 professionals and about 200 next year, and then we'd like to go to 400, and then 800, and then 1,000. And the idea is that you need critical mass placement capabilities to get things done. We'll actually integrate the CoreConnex technology because I think it's a very intelligent and well thought out compliance-oriented suite. And I think it will help us systematize a lot of the work and cross the T's and dot the I's that we need to in private markets. But the sales are still going to be made ultimately by individuals who are licensed with in the United States with the Financial Regulatory Authority through Weild Co. And they're going to need to, call their clients up, have a conversation, send them the documentation, tell them why they think it's appropriate for that particular client.
David, and all of that relates to the initial offering of securities on private markets. But like one of the biggest promises of tokenization that everybody is talking about is liquidity. And you touched a bit on that already. But my question is, do you believe we will see this kind of secondary market for securities of privately held companies? And when that will happen? Because right now the secondary market for tokenized assets is so insignificantly small that it's hard to talk about any kind of liquidity yet.
Yeah, actually it drives me nuts when I go to conferences and speak and I hear people talk about liquidity as being one of the great advantages of the crypto or token market. Because all of the rules that apply, remember, I was vice chairman of the NASDAQ stock market. I grew up running an equity capital markets group at a top 10 Wall Street firm. I understand market making and liquidity, and the rules that govern market making and liquidity with a traditional security are really no different than with a token, okay, than with a block. There are some things that you can gain incremental advantages from, like the automation of documentation and paperwork, for example, all the legal documentation that is very laborious for the transfer of in the private markets of shares from one qualified investor to another qualified investor. So it'll take some of the cost out of the equation. But it doesn't mean that it's going to make the security liquid. Somebody still has to get on the phone and be able to tell the buyer on the other end why this is an interesting investment for them. And so that high touch piece of things, which is so lacking in today's public markets because of the electronic automation and the collapse of all the economic incentives, because commissions are so small and in public markets and trading spreads are so small, that people can't make a living picking up the phone once things are in the public marketplace. In private markets, you're going to need an army of people that are guaranteed of making a certain amount of money, stepping into the middle and calling up Masha and Xenia and saying, hey, I have something that I think you'll be really interested in. You should take a look at it, because you've got a seller on the other side, and you potentially could be a buyer for that security or that token, right? So just because it's tokenized doesn't mean that it's going to be instantaneously liquid. There are certain kinds of assets that will trade better because they're better supported by the nature. They're easier to understand the value. And so, for example, real estate, it will typically pay a distribution. And that has a bond-like element to it. And it also has assets that are relatively easy to value. So you can figure out what the value of that is. So the market tends to make it easier to trade those kinds of assets, whether it's public or private, around a reasonable price. But when you get into early stage life sciences companies, pre-revenue, somebody has to do the research. Somebody has to, it's a very complicated story. They have to get on the phone. It's very high touch. And just because you tokenize that particular company doesn't mean that you're going to make it significantly more liquid than it otherwise would have been. Does that make sense?
Yeah, certainly. And I think I have one question in this regard. I think just last week, SEC announced an open call for submission of ideas related to infrastructure for thinly traded securities. And we know, like, some people from the tokenized asset space saw an opportunity in this, that like, hey, we have a solution that might be beneficial. And I think they're mostly were addressing to that it can significantly cut transaction costs. What do you think?
First of all, Congressman Emmer of Minnesota, is a Republican from Minnesota, had sponsored a piece of legislation on venture exchanges called the Main Street Growth Act. I think that was the name of it. And it was essentially going to allow, it had been actually passed through the House of Representatives 406-4, okay, which is wildly bipartisan. Democrats and Republicans both supported this. You can't even get a proclamation to support motherhood and apple pie through the House of Representatives 406-4. And this omnibus bill included a lot of other pro-growth legislation, went through the House in the last Congress, and then when President Trump shut down the government and there wasn't a budget, it was supposed to, the bill was supposed to have gotten tacked on to the Senate Appropriations Bill. It didn't get, there was never a Senate Appropriations Bill because they shut down the government to build the wall. So it pushed the legislation into the next Congress. The Democrats took over. But what that does is, because it wasn't passed in the same Congress session, it set the legislation back to zero. So we have to start again. That legislation, which I think was incredibly enlightened, basically would liberate stock exchanges from for companies under $1 billion in market value from a lot of these regulatory requirements that collapsed the economic incentives and made market making impossible. I think that designing a market which is optimized for the needs of smaller capitalization stocks, as opposed to the one we have today, which is optimized for the needs of larger capitalization stocks, is absolutely essential to long-term prosperity. But it requires a balancing of interests. And those interests are, there are three interested parties. They are the intermediaries, most notably the investment banks, because they're the ones that take companies public and support them in the aftermarket. And the issuers, because it has to work for the corporate issuers, or they're not going to want to access public markets. And then the third group is, of course, the investors. And what we have in the United States is a marketplace, in my judgment, that largely favors not just not investors per se, but the subset of investors that are mostly traders, right? They're not, this is not about preserving long-term value, and it actually degrades what I think are the most important investors, who are the incumbents. They're the ones that took the early risk to get a company to the point of going public, and now they become preyed upon by trading interests that engage in illegal short selling and all kinds of nefarious activities. And so we absolutely positively have to have a market that addresses those issues. I'm not sure, when I see I'm going to respond to this, obviously, at some point, the Securities and Exchange Commission's request for comment. But just because you concentrate liquidity on an exchange, that may help on the margin for a micro-cap security, but it doesn't necessarily provide support for that company in the public marketplace in the form of research, sales and distribution, and a capital commitment, which traditionally comes from the sell side firms, the Wall Street investment banks. And so it was actually one of the great, and I think catastrophic errors in judgment on the part of the SEC when they did the pilot on tick sizes and decimalization, and they tested a variety of tick sizes, but they gave it over to the stock exchanges to design the pilot. And that's a little bit like the fox guarding the chicken coop. When you really need to design a pilot that the investment banks that take companies public will support, right? That they will find that they can take more companies public and get them supported adequately, make money in the aftermarket. It was about investment banking profitability, not stock exchange profitability. And so they gave it to the stock exchanges to design the pilot. And of course, they came out with a poor result. At the end of the day, we need microcap securities, need more people providing research, more people getting on the phone, telling people these stories, more capital committers. All those things need to come to bear if you're going to create liquidity. That's the liquidity package. Liquidity in microcap stocks is created by intermediaries. It does not happen organically, right? Yeah. And so until you can rebuild the ecosystem, and it may take many years with the proper economic incentives to rebuild that ecosystem, you're not going to bring back the volumes of, for instance, initial public offerings in this country that we need to bring back. I'll show you how extreme it is. We went from 9,000 publicly listed operating companies down to 5,000 when they dropped the bottom out of the small IPO market. But more importantly, if we hadn't changed market structure from where it was in the early 1990s and automated it and collapsed trading spreads and commissions, we might be looking at 15,000 or more publicly listed companies today in the United States markets, and when we're only looking at 5,000. So that's a massive shift, and obviously that represents a lot of quality job formation, a lot of upward mobility, a lot of innovation, U.S. competitiveness. It represents a much bigger tax base that would fund the U.S. Treasury. I mean, there's nothing good that came out of, from an economic perspective, the current market structure of low-cost trading, one-size-fits-all markets that ended up disintermediating the intermediators that were required to support the small capitalization growth engine of the U.S. economy. Does that make sense?
Yeah, yes, certainly. And my next question, I actually want to ask you about one important part that is a big, huge part of the blockchain-related rhetoric, and this is democratization. And you are known as the father of the Jobs Act. And I want to ask, do you think that actually democratization is about giving people an opportunity to invest, like retail investors, into some of the deals that they previously didn't have access to? Or is it about something else? And what's your general outlook on this and the role of tokenization in this process?
Well, democratization is a very great and simple concept, but I think that you have to add to that knowledge and the opportunity for upward mobility. So for me, one of the things that I lament when you look at economic data in the United States is the loss of upward mobility, the decline in the number of startups. I mean, when I was going to college, it's quite a long time ago, nobody taught entrepreneurship in this country. And now every university in the country seems to teach entrepreneurship, yet we're at a 40-year low in the rate of startups. Now, some would say that that's because of big box retailers and some secular trends that have gone on, but it actually in the last decade, there's been a real abrupt, I looked at US Census Bureau data on this, and it appears that the startup rates over a 10-year period just got cut in half. And I think a lot of that has to do with the amount of capital that's making it down to earlier stage companies. And if you raise the bar so high that it takes many more years for a company to go public, then private investors are not getting the return and the velocity on their capital, and they're the ones that invest in earlier stage companies. So I think that what we've done is we've unwittingly we've choked off access to capital to private markets, and so certain places become haves, like Silicon Valley, that's created its own ecosystem, right? But the rest of the country becomes have-nots, and it's exacerbating this kind of flyover state phenomena. So if I was to go stump for the 95% of U.S. states or the 90+% of U.S. states that are in the have-not column, and which is one of the things that we'd love to do at some point on public policy, I think that we will be very successful at convincing Congress, hey, we need more economic opportunity and investment and startups, if you will, in the heartland, in the rest of the country, and it can't be concentrated into so few places if we're going to have sort of a more perfect democracy. We have to restore upward mobility and tangibility to the American dream. We have to be able to go into, the inner city where I've got a really gifted African American kid whose friends and family don't have money, and he needs to raise capital. Who's going to have an incentive to look at his business? Because most startups are funded by friends and family initially. So how do we actually make it worth the while of people with money to look at businesses where they're actually created in areas of the country that don't have money? And this is all ultimately about capital flows. And if you get the carrots in the right direction, the incentives and the disincentives in the right direction, you get outcomes that are highly desirable. If you create a set of incentives and disincentives that put it in the wrong direction, which I would argue is what we did when we went to penny tick sizes, electronic trading, cut commissions and trading spreads in public markets, then you get these unintended consequences, which are you drop the bottom out of the small IPO market, which in turn drops the bottom out of startups, and you undermine long-term U.S. competitiveness, which is clearly not what policymakers should want to do.
Yeah, thank you, David. And I probably have one last question for this interview. So you, throughout your career, have guided marketing, placements, pricing, and trading for over 1,000 of securities offerings of different companies. What advice would you give to a company that is looking to raise money via security token offering?
Well, you have to have a terrific, distribution and investor outreach process. It's the number one thing. It's how many qualified investors do you get in front of, and that means that I think too much of that burden now is being put on to the backs of management, whereas it used to be actually picked up by the market. We had 100,000 plus retail brokers in the United States, maybe hundreds of thousands, that actually distributed securities and redistributed them in the aftermarket. And now with the collapse of trading spreads and commissions, they now become financial advisors doing allocation advice to funds mostly, not to individual stocks. So that means that management teams need to take over the function that Wall Street used to provide. You can obviously find folks like Weild Co, other broker dealers, other investment banks, but you can't underestimate how much labor and how much organization and how much resources you're going to have to invest in investor outreach. It becomes almost a full-time job for some members of the management team. And I'll give you a case in point. I'm working with a public company right now, and it's about $150 million in market cap. It was in the over-the-counter market. We uplisted it. We took a completely different tact because we recognized that Wall Street firms that are dealing with microcap securities actually are throwing those companies in front of the bus, so to speak. They're putting them in front of investors that don't invest fundamentally. They invest on structure. So they want a big discount. They want a warrant attached to it. They want to do things that are incredibly dilutive. They short the stock prior to the offering. We said we have to avoid that part of Wall Street, which is the only Wall Street that's left for small public companies, and we need to internalize a brokerage force in the company. So we hired 2 former retail stockbrokers. We hired 2 juniors to support them. The CEO probably spends 50% of his time going out in visiting investors who are part of the affinity group. The company's in the medical device field, so they have a natural, they obviously talk to a lot of sophisticated doctors that have interest in the technology. And now recently, because the company's gotten bigger, we've added somebody who used to be in the institutional equity sales department of a Wall Street firm. He was an institutional salesperson that has relationships with those accounts, and somebody who also comes from the family office community. So we are effectively doing inside the company what Wall Street used to do. And I can tell you that so far it's been very hard to pull off, but it's been much more successful. And when we raise capital, because this is a pre-revenue company, we've been raising capital directly, not through Wall Street. We've been going direct to investors. And the company now has a database of 18,000 investors and contacts that it communicates with regularly through its CRM system, its customer relationship management system. It's a very radically different approach. I wish it weren't necessary, but it's a sign of the times. It shows you that what we have as a market structure, at least when it comes to smaller companies, is a complete failure, and it demonstrates just how much focus and attention management teams have to put on to the capital raising process. It doesn't just happen the way it once happened. It used to be that you could run your business and you could get people to support and raise capital for you, and as long as the old adage was, if you build it, they will come. If we build it, they will come. And today that's not the case. If you build it, you have to go out and grab the investors by their shirt collars and drag them across the transom and convince them that what you're doing is worthy of their investment dollars.
Okay, David, thank you very much for this interview. It was extremely insightful. And I'm pretty sure that many companies working in the digital asset space and those looking to raise funds with the security token offering will find it extremely useful. So thank you very much for being with us.
Yeah, thank you.
Yeah, nice to see both of you again. Take care.
Thank you.
Thank you.
Bye-bye.